The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show, one of my favorite people to talk to. He is the co-host of Macro Voices. His name is Patrick Ceresna. Patrick, welcome to the Rebel Capitalist Show.
Thank you very much, George. Great to be back.
Now, today, I'm super, super excited because a couple months ago, I did some whiteboard videos on Chris Cole's paper that everybody is talking about. It's the Dragon Portfolio. His paper, allegory of the serpent and the hawk, or the hawk and the serpent, something like that, was just hugely popular all over FinTwit. And it's a relatively straightforward portfolio, except for a couple key components. So I said, Who can I get on here to explain this a lot better than I can, so the average retail investor can actually put into practice what Chris Cole is talking about in this Dragon portfolio. And I said, I got to get Patrick on to do this. So Patrick is here today to give us the knowledge bombs that will help us take it to the next level. So Patrick, I'll hand it over to you.
All right. Well, thank you, George. And so, yeah, we had this conversation about talking about how to take a portfolio and build a Dragon portfolio for a retail investor, because it's easy at the institutional level. You can literally outsource this to people like Chris Cole, who will actually build it with real money. But the average retail investor doesn't have the ability to access the Chris Coles of the world. And so what we wanted to do is let's just quickly go through the concept first of all, and then we'll talk about the breakdown and then where the issues are with all of it. So we want to start off by talking about this idea that we have over the last 30, 40 years been in what's called the standard market cycle, which is founded on fundamental growth and very normal market conditions. And the economy is expanding, and then it reaches a point where the cycle is ending with huge amounts of leverage and debt expansion in the system. It becomes bloated.
Clear, this is a cycle where the typical 60-40 portfolio that most of my viewers probably have, the risk parity portfolio, does very well. Yes. But when we go into the next cycle, it doesn't do well at all.
That's right. What happens is that inevitably some period of a new secular change occurs to reset the system. And this is the key is a lot of people love to boogeyman the reset of the cycle, right? Like you have the Peter Schiffs of the world the world is ending, and but it is a reality of what happens in these cycles. It's happened over and over again through hundreds and hundreds of years of history, and we go through these expansions and contractions and resets, and everything ends up working out in the end. But a portfolio though doesn't work the same in one of these periods of secular change, and there are two ways, and at least Chris Cole describes it as two ways of that cycle resetting, and it calls it the two wings of the hawk, right? It could be a deflationary path, or it could be an inflationary path from which this occurs. And the idea Chris Cole was bringing up was, how do you build a portfolio that will do well in both of those conditions? And so from all of his research, he basically came to the conclusion that he was going to build this Dragon portfolio that had roughly equal weightings into equities, bonds, gold, commodity trend following, and long volatility. Right. And a lot, that's pretty amazing, because even for most investors to even have 10% allocation to gold would seem actually like a very large weighting. But in the Dragon portfolio, it's almost closer even to 20% weighting in there, on balanced with equities and bonds. But almost every investor knows how to do the first three, which is I'll buy an S&P 500 index or a basket of equities. I know how to buy some sort of bond basket, or how to buy gold bullion. But then we get to trend following and volatility strategies, and this is where most people's heads start spinning. Exactly. and it's like, how do I bring these things into into the portfolio? So that's where me and you had the conversation, and we'll say, let's find a way for a retail investor to be able to add some of these strategies into their portfolios at a retail level. And so in today's session, what I wanted to do was talk about the volatility component. And when you have me back, we'll talk about trend following and some of the some really neat ways that people can follow trends. And so the ways that I would look at this for a retail investor is you have to access the traditional options market to be able to go long volatility. Now, sophisticated money managers that have access to institutional level accounts can have all sorts of special over-the-counter derivatives and other things constructed to be or hire a Chris Cole to do these things. But I want to talk about what we know, that retail investors can access the exchange traded options market. And so an average investor would be able to put on a number of these basic strategies in order to be long volatility. Now, there's all sorts of ways that we can implement long volatility, everything from straddle, strangles, and to back spreads. And what I want to do is I want to focus on, first of all, explaining what a traditional payoff profile is of a call option, and then talk about why something like a back spread fits the bill to the way Chris Cole described this kind of low carry, long volatility strategy that buys you all this gamma. And so I want to just
And what is gamma?
Well, actually, I'm going to explain it right now when we get to the
great.
slides, right?
Great.
So what we'll go through this whole process. And so what we want to do is I want to just start off with what is the traditional payoff profile of a long stock position. It's what's called a delta 1 position, which is a 45-degree angle. And it's the very binary relationship of if every dollar the stock or security goes down, you lose $1, and every dollar it goes up, you make $1. And it's a 45-degree angle, straight binary. There's no special structure to it. It's very clean. And most investors experience this very profile, this delta 1 experience. Now, the most traditional way a retail investor enters the options market is with just the purchase of a straight out long call option. And a long call option gives you the upside to the right, which is that if the stock goes up, you're participating, but it comes at a limited risk, which is whatever premium I paid for the call option, I cannot lose more than the premium I paid. Now, this here is the very traditional long call, but what happens is that there's a negative carry. In other words, even if the stock stays the same, or even goes up just a little, you are still in a position of losing money with a call option. Your call option payoff is that you have to beat the capital you outlaid for the call option on the upside of the market. And so this is where this term of negative carry comes in, and we'll talk more about it. But this payoff profile we're looking at on a call option is only the chart at expiration. But what you can see here is the blue line that I put on here is the shape of the curve or the slope of a call option in the middle of its cycle. It's not this clean cut 45-degree angle lines that are very straight. It's the slope, and this slope is the delta of the option, and the rate of which that slope is steepening or flattening. It's steepening or flattening at the rate of gamma. Now, this is all more complex options math that is the next layer of understanding. But the most basic understanding that you want to think of, and if I just simplify it for your average listener, is the very simple thing. We pay a premium to buy an option for its optionality, which is the more I am right, the more the option behaves like the stock. And the more I'm wrong, the rate of loss is slowing to the point of that I can't lose more than the premium I paid. And this creates this optionality curve, and you're paying for that. That's what it costs, a premium for the slope of this line. And so when we have one of these options, this is where what I want to do is talk about what this gives you. So buying an option, you profit from the directional moves. When you pay the premium, you are long gamma. You are basically buying the upside or the downside of the market with put options, or the upside with call options. You're buying gamma. And you also, when you go long options, are buying volatility, because as volatility increases, the options become worth more. In the options world, we call that being long vega, or volatility. And so it's all the amazing things about being long an option, which is that if there's a big move, it makes you a pile of money. And if volatility explodes while you own it, you also make a big pile of money, but it comes at a material cost. And the cost is the premium we pay to buy the option. And the premium is time decaying, which is what we call the negative carry cost.
Yeah. So let me just kind of unpack that really quick here. Tell me if I'm right. So I want to buy an insurance policy for the world coming to an end, right. For Armageddon, yes. And I'm going to pay $100 a month for this insurance policy, and it's good for, let's say, 20 years.
Right.
And so I'm paying $100 or $200 a month for this insurance policy. What happens is, if everything is nice and smooth, stock markets that are an all-time high, the birds are chirping, everything's great, unemployment's at 3% and headed down, we're all in this nirvana. Well, I'm going to be able to buy that option, or that insurance, very cheap for a low monthly premium. But what happens, let's say we get 5 years into it, so I have 15 years left on this policy. Then we have riots, we have looting, we have social unrest, we have the coronavirus, we have unemployment headed to 20%. Who knows what's going on with the deficits and MMT and helicopter money and everything else. So everyone that doesn't have that policy says, listen, I would love to own your policy, George, that you have for the next 15 years. You're paying X for it. I'll give you Y for it. I'll give you a lot more than you paid for it right now, because I don't have any insurance and I want your insurance. So you can sell it to them and make a profit that way, or you can hold it for the 20 years and let the entire world crumble around you, and then you can exercise the option. So those are the two things we're talking about, right?
Right. And so so they are, but they're mutually beneficial in a sense that you could have a directional move. So let's say you're long a put option, which is betting that, for instance, a deflationary asset price impulse, which would cause stock prices to decline, but volatility tends to rise in that environment. And so you are actually profiting twofold, because you bought the put option in a low volatility regime, and it's transitioning to a high volatility period. So you're profiting from the prices are moving in your favor. You're long gamma on the left wing of the curve, which is basically the market declining.
Yep.
And at the same time, volatility is expanding, and therefore the premium of your option is also increasing. So in fact, sometimes you can get extraordinary payoffs on put options during a market crash if you are benefiting from both inputs at the same time, right?
Yep.
And so we'll talk about this as insurance here right now, but the essential issue with buying calls or buying puts in general is that negative carry drags your performance. If you are that, so if I'm continuously buying stocks and buying options with it as a portfolio component, the options, if they're doing nothing, are just dragging my performance because they're time decaying. And so the question then becomes, how can you create a option strategy that reduces the negative carry? How, like, in other words, it doesn't act as a major burden to your portfolio while you have it there as insurance.
Yeah, it offsets that monthly insurance premium.
Well, offsets, but it's some way of neutralizing its impact. So this is where one of the strategies, and I emphasize one because there are a number of ways that even in Chris Cole's paper, he talks about the idea of a rolling straddle Straddle and all sorts of different types of things to do. So I want to focus on just one of the ways, and we'll just unbundle this one and try to have all of your listeners understand this one strategy.
Okay. Great.
And so we're going to do this callback spread. And so this is where we want to talk about different ways of going long volatility in a portfolio. And so the first thing that we want to talk about is many people perceive, and just like you described in one degree or another, and actually we've been talking about with long calls or long puts just a moment ago, is that hedging tail risk is just essentially buying insurance. All right. And so at the same time, when you want to alternatively buy volatility, it's also, though, trying to therefore minimize your carry cost when you're actually in this trade. So generally the goal, and what professionals such as Chris Cole try to do, or other money managers that are buying gamma and all these other things on the wings, is that they're trying to say as well, some years you're going to be up or down, but generally it's a much better carry cost than just outright buying insurance.
Okay.
Right? Like we have to find some way to be long all this gamma, but and not be taxing to the person that is building this into their portfolio, where it's ruining the performance of all the other things in your portfolio that are working.
Right.
And so this is where we want to talk about what are the ways to do this. How do you build one of these portfolios? There are two ways of buying insurance. Like now, for instance, let's go back to your analogy of insurance, and let's talk about generally car insurance. Let me quickly go back to this one slide here. When you buy car insurance, on balance, the vast majority of us are net losers on car insurance, which is we are not the ones that need the payoff. Now, if you're unfortunate that you actually needed the payoff, it's because you were in a bad accident or had massive liabilities because of it, and you turn to the insurance policy for to cash it in and get the payoff. But for the majority of us, we're losers on the insurance because we never end up having to crash our cars or do anything, and our contribution to the insurance was helping the other person, and that's like the mutual.
That's why they sell it to you in the first place, Patrick.
Yeah, there you go. And so on balance, in the same way, always buying insurance on the stock market perpetually is a losing proposition that drags your performance. Right. If and this is where Chris Cole spends so much time trying to say, how do we go long volatility without all of this big negative carry in a portfolio construction? I mean, we have to assume that not every one of your listeners is a professional market timer, because for people that tend to use options in trading, they tend to be market timers. They tend to have an intuition as to going up or down, and they're using the option as a tool. But what we're talking about here is someone who just indiscriminately buys insurance perpetually in their portfolio as a component of building it out. So now, then let's talk about the ways that most people perceive buying volatility. And the most common way that most people will tell me is that, well, when you're going long volatility, that means you're just buying the VIX, right? Like that's the most common way that most people will say, like you're just buying the volatility index. And now this is actually not the way Chris Cole is going long volatility. And I mean, there might be a component within his portfolio where they are long volatility, like the volatility of volatility or some other component. But those people that are trading the VIX or volatility index, they are trading a game of trying to forecast where volatility itself will go. Where like they're saying, I think volatility will go from 20 to 40. They're looking at this one big payoff where we go from a low volatility regime to a high volatility regime. And they're trying to profit from forecasting the fact that they believe that this transition is going. The problem is that volatility itself is not a very good portfolio hedge, because volatility itself is agnostic to the direction of the market. So on some of those biggest up days that we had in the stock market off of the market low, they actually occurred in a period when we had very high volatility. So volatility, while the natural tendency is volatility trend spikes higher during market crashes, it's really a forecast of what is the implied daily range. Even though implied volatility is annualized, it is based off of what is the implied daily volatility of the market. And during market crashes, or like for instance what we experienced in February, March, and April on the way down and back up, they were very big days, like days where we had 2, 3, 4, 5% moves in one day. And so that was a high volatility regime. And so when you go long the VIX, it's a one-time payoff of you believing that that low volatility period will transition to a high volatility period. And that's great, but that's really not a portfolio hedge. That's just really you making a bet that volatility is going to change right now in the period from which you've went long.
It's not something you want to keep in your portfolio for 10 years.
Exactly.
And just set it and forget it. Because, correct me if I'm wrong, Patrick, but a lot of the people that try to play the VIX, that they'll buy like an ETF that tries to track the index, and there's a negative carry to the index, just like
from
USO.
The contango roll.
Yeah, the contango roll. Yeah,
it's brutal. And so that's the VIX index itself. But even buying options on volatility, now you're dealing with the volatility of volatility. It's just it's a very sophisticated and complex thing that you want to leave to more sophisticated investors. And some of the people that are listening may be more sophisticated and they can be doing that. But let's say the average person, it's usually over their head to be trading the VIX itself and trying to make that forecast.
Yeah, and I just want to just hammer on that one point, because everyone comes back and I just want to be very clear, guys, to be redundant here. If you're buying an ETF that is supposed to quote unquote go long volatility and you hold it for 10 years, you're going to lose money. Yes. You're going to lose money because it's only going to go up when volatility spikes. And in the interim, there's a negative carry. There's this negative decay. I don't know what the correct word is, Patrick.
Yeah.
But the bottom line is they're always rolling it over. And every time they roll it over, most often the fund itself is going to lose money. So it's almost 100% guaranteed to lose money if you hold it over the long term. I just want to be very clear with those ETFs that say they track the VIX and go quote unquote long volatility.
Right, because there is no real volatility for them to buy, so they're buying VIX futures, and exactly. VIX futures have a term structure the way oil and natural gas and all the other futures have, and volatility is it tends to have be in trading in contango, which means that it's always more expensive to roll it forward, and therefore often as much as 5 or 10% tax a month is being hit on somebody that's holding a long volatility ETF. It's just not, like, I would highly recommend and make this very clear. If you want to add and build a dragon portfolio, adding a VIX ETF into a 20% allocation into your mix is a very bad idea. That is not what Chris Cole meant, and
exactly.
and you do not want it's just not going to be a winning proposition for you to follow that path.
Yeah, that's the point I wanted to make. Just like the USO oil ETF, it doesn't have the underlying asset. It's the same thing. You're going to lose money long term. Yep.
Right. And so this is where we want to talk about the second way of being long volatility, which is what Chris Cole was talking about. And that is being long gamma. And that is being long the trend effect, which is that there are these periods where in a trend move of inflationary and deflationary impulses, where trends persist day after day after day, and these big moves happen through these big, huge inflationary impulses. They often happen in currencies, in bonds, in commodities, and we'll talk about that when we talk commodity trends and commodity trend following. But these big trends develop. And being long gamma means that when one of these secular changes comes in, where one of these extraordinary moves are happening, you've built a portfolio that is either hedging your portfolio if that's a deflationary impulse, or accelerating your returns if it's an inflationary one. It's supposed to protect you on when one of these wings of the hawks a hawk occurs. And so this is the idea of being long gamma. So the callback spread we talked about here is one of the ways from which you can do it. There's multiple ways, but this is just one. And I think this is a straightforward way to explain how the strategy works. And so what this involves is a combination, like a spread trade, of selling a call option and subsequently buying two higher strike priced call options against it with the same expiration on the same underlying security. And the goal is to try to actually open this at a net zero cost. And so what happens is, if you recall the payoff profile we described earlier of that hockey stick shape that curve had, we now create a payoff profile that looks like this, which is essentially there's only one real kind of dangerous spot where a bigger loss can occur. And so what is the key to a ratio call spread? Well, or back spread, is that when you have a scenario where the stock market is declining, the call back spread just literally expires for no loss. It literally had no carry in a period when the market was going down. At the same time, if you had an extraordinarily big move to the upside, it has a huge payoff. So a call back spread on the stock market would be an inflationary impulse, but at the same time, if we were talking about in bonds or in gold or in commodities, the call spread has a reverse, or interest rates. There's or currency, like on the U.S. dollar. When you're Chris Cole, you're opening these call back spreads on every asset class. This is not just stocks. And so what happens is when one of these extraordinary inflationary, deflationary moves happen, you have this big payoff, at least in the calls, on the right tail. And so right tail call back spreads are most commonly biggest payoffs are when on gold and on bonds, because usually when the stock markets crash, bonds interest rates tend to decline and bonds rocket higher. And so a call back spread on bonds, for instance, paid off extraordinarily. Like we had one open on the TLT on treasury bonds during the last crash, and the market just blasted off to the upside in this extraordinary way. At least treasury bonds did, in return for the fact that interest rates were declining. And so you create this scenario, and that point of risk is where the security goes up a little, but not a lot.
The underlying security, okay.
Underlying security goes up a little, but not a lot.
And Patrick, why is there no loss? Why is there no negative carry? Because you're selling the call, so you're getting a premium while at the same time you're paying a premium?
So let's take an example of a call spread on $100 security, right? And so you have, let's say, 6 months of time on this. And so right now you would sell a $100 call option for, let's say, a $5 credit. And you are therefore, let's say, receive $500 income for selling that call.
Okay.
But you use the proceeds to buy two call options at the $110 strike, and each of those are $2.50. Obviously, I just use round numbers. In the live market, they rarely will be a perfect zero cost debit. There's usually some form of a debit or credit in the process of opening them. And sometimes in a very low volatility regime, you can even open a 3-to-1 or a 4-to-1 ratio on these and really buy a huge amount of gamma on those wings. And the point, though, is that it's a zero debit. It didn't cost you anything. So this is why when the market was declining, both calls, the long and the put ones, expire, and it was zero debit cost. And so therefore you lost nothing. There was no carry cost. So if the security literally stays the same in price or in any ways declining, there is zero loss on a callback spread.
Yeah. So just quick question, Patrick. I think what most people will be asking is say, listen, if I'm selling something for $5, why is someone buying two of what I'm selling for $2.50? And I think that goes back to the timing of when you're doing this transaction relative to volatility. Is that
Well,
correct?
you also want to notice that the $110 strike is $10 higher. So
Oh,
the
okay.
option
Got it.
the
Got it.
option is on a probability adjusted basis. Our right to buy is actually $10 higher. We're buying something that is that needs to move greater, and so
Okay.
what this
Got it.
does is it allows you to be long volatility and long gamma, but at the same time, it also means that you can generally be able to put on this trade for a very low carry cost, because if the stock market is more or less staying the same or remaining unchanged or even going down a little, it doesn't cost you to be long gamma. It's not like buying a call option that is just going to be time decaying and expiring at zero cost. And more importantly, what we do want to reflect upon, George, is that Chris Cole was talking about this as a component of a portfolio. In other words, we're not buying this callback spread because we think that this is going to be an extraordinary performer. We actually are buying it just in case shit hits the fan, and some event is occurring, and suddenly we're taking big losses on other parts of the portfolio, and this, like an insurance policy, pays off in a big way on the wing. And so we, for a balanced portfolio, this is playing a diversifier role, something that will actually do very well when the rest of your portfolio is in turmoil.
Yeah. Yeah.
And
It complements everything else. This is the
exactly.
cranberry sauce at Thanksgiving dinner. You don't want
Right.
it the whole meal, but it's very good to have.
Right. So the long equities is the turkey, and long bonds the
Yeah.
potatoes,
Yeah.
and
And by the way,
all the
Patrick's Canadian, so I'm very impressed that he knows this stuff.
there you go. And but so nonetheless, it's this idea that you are that you basically have this as a complement to your portfolio.
Yeah.
And so this is one of the ways to do this. Now, there's a couple of interesting things that are important to note. Notice that this very deep shape V at the bottom of the loss occurs, in this case, would be occurring at $110. So if the stock was exactly at 110 at expiration, that would be your max pain point
Okay.
on this trade. But there is a couple of really interesting things. And if you really listen to Chris Cole's interviews, he talks about the active management of a long volatility strategy. One of the more interesting things about being long a ratio back spread like this, or a call back spread in this case, is that by closing it early, let's say I bought 6 months and I was rolling it every 3 months, right? So every 3 months I would close it and buy another one that's 6 months out. You will never actually experience the great loss at that V point, because there will always be time value on the long calls against the short call, and therefore you may be down, but you will never be experiencing max loss. And so the active management of rolling one of these call back spreads, which is actively managing your portfolio, allows you to always have gamma and never experience the max loss.
Okay.
And so this is one of the really fascinating things about owning that option. The second thing is that because you structurally have less risk, you can actually size your position even larger. So if you turn around and even that max risk point is a fraction of its size because you never hold till its maturity, you can actually increase your sizing of the spread. And have even more gamma. This is why actually one of the most exciting times to be going long volatility is in a low volatility regime, like back in January and February when the VIX was down at 10 or 11. And a lot of people perceive it that's because you can that you can buy the VIX down there and it jumps to 40 and you make this money. But no, in fact, what it is that the ratio spreads and all these other ones can not only be bought with more narrow spreads, but they can also be bought in larger ratios. In other words, you might be able to sell an at-the-money call and use the proceeds to buy 3 or 4 calls that are out of the money. Now you've bought a shitload of gamma. Right. Yeah, like at this moment,
and instead of $100 and $110 spread, it could be $105.
Exactly, it could be 100 to 105. And now when volatility really accelerates, you suddenly have this amazing period where and so this is why what happens a lot of times, what the professionals like Chris Cole, what they'll do, and there's other great managers that do this as well, but what they're doing is they're saying, well, if the volatility is high in equities, there are other assets that are correlated to equities that don't have the same high volatility. So why don't we put this ratio spread on in some other asset that is going to move when equities move as well, but we're able to open it at a much lower vol premium and a much easier carry cost. Like this is what they're doing. They're analyzing the markets all the time and saying, where can we put these long volatility trades on for the best payoffs and the lowest risk and the least carry and all these different things. That's why they're professionals. That's what they do, right? And they're perpetually looking for a way to actively manage that. But the one last thing that I wanted to just highlight was that you're also long volatility because you're long Vega. And so this is also a synthetic way of playing the VIX, because in the end, you put on more call options than you are short on the market in a low volatility period. And as volatility expands, then you are actually going to see a net profit on your volatility expansion, even if the security doesn't move. And that's the cool part is that actually you have with this particular back spread strategy, you actually can be long volatility itself by having it implemented. And that's the same for straddles and other things. I mean, in this session, we only covered just the one strategy, but there's a whole array of really cool strategies to do this, to have lower carry costs and ways to actually implement them, right?
Yeah. So the next question would be, Patrick, well, when are you going to teach us that? I mean, you've given us this part, but man, there's so much more to grasp. And I want to be very clear. This seems incredibly complex for the average Joe or Jane, but and we're talking about Chris Cole doing all these complex things, but guys, we don't have to be a Chris Cole. We don't have to be a professional to leverage the power of this concept within our own portfolio. We might not be able to maximize like a Chris Cole, but we can definitely use it to our advantage if we understand some simple concepts. We've gone over one thing here, but it sounds like Patrick has got a lot more tricks up his sleeve. Is that correct, Patrick?
Of course. That's what I specialize in. Oh, listen, you know what? We had a great time doing that live session. Anytime you want to invite me to do another live session with you, we can get on there and share that with your listeners anytime. Well, you let me know.
Well, I think that'd be great. And just to remind everyone, Patrick and I did a 4-part series a couple months ago, where at the end we did this kind of live webinar where we brought people on, and Patrick actually went into the market and made trades. And this is when we were teaching everyone about options themselves. So
it was particularly on gold too, right?
That's right. Yeah, on gold. So now we could maybe just do the exact same thing, but focus on the Dragon portfolio. That would be very cool.
I'm totally cool with that. If you want to do a session on how to actually put on some of these trades, I'm happy to do it. You know, it's a good thing. Like, you know what? There isn't, when you do something like putting in one of these call spreads, there isn't a lot of risk to doing it. Even if you held it to maturity and the absolute worst scenario happened, it's still an incredibly modest loss in the context of a balanced portfolio and what the objective of the position was all along, which is to be long gamma for one of these big extraordinary moves. And I can't think of a crazier time in the market than now, where we had the Fed basically have to expand its balance sheet in historic terms in order to fight this economic recession that was induced from the corona, and so now we have a scenario where one of the hawks of the wing, so wings of the hawk, could actually start to materialize. Maybe a major secular change may be afoot. And for an average investor to just have a few of these long volatility strategies complementing their existing portfolios, the best part, it doesn't actually take a lot of money to open these trades. Even if you don't want to sell any of the securities, like for instance, something like the this back spread that we talked about is a zero debit. So it actually doesn't take any cash to open it. And the margin that it takes to securitize it, which is the spread between the 100 to 110, could be collateralized against the margin of your equities that you own in your portfolio already. And so you can just take your existing portfolio and immediately implement a couple back spreads to just complement your portfolio mix. And it's something that can be done. And what we can do is, if you want to do a live session together, we can maybe announce it next week. Well, let's talk about it. We can talk about...
Let's definitely talk about it. I think what people really need, and what I would love to see, is, okay, I get the concept, but how, I mean, what button do I push? Like, how do I do this? Just step 1, step 2, step 3 to
Let's
make
actually
sure
place a
I
trade.
want to do this, that we can do it, you know. And just to be clear for everyone, what's great about this is, and I hear this debate all the time, and Patrick, I know you do too, on Macro Voices, where you've got people that are in the deflation camp and people that are in the inflation camp. The problem is that portfolio is wildly different. It's basically complete opposites. But what's neat about this is you make money whether we're going into deflation or inflation. It works in both situations. So,
and more importantly, for instance, let's say an inflationary impulse leads to huge asset price inflation, and in fact, commodities and so trend following commodities and all the equities start actually appreciating in a period where the dilution of money is occurring at such a rapid pace. So the denominator is being hammered on money, and so in that period, if you were just buying, let's say, back spreads to ensure a deflationary impulse, well, they're going to expire at no loss to you. In other words, you had the insurance for a deflationary impulse, but the inflationary one was the one that manifested itself. And in doing so, now you didn't really lose for having that insurance, that low carry cost that Chris Cole was talking about. Like, you don't want to burn huge amounts of premium buying insurance and then watching it time decay. You want to have that tail gamma, that way of being long these big moves, and we can do it. I'm happy to show all of your listeners how to put on a couple of these trades and hedge their existing portfolios by being long volatility. Absolutely, bud.
Okay, cool. So let's talk about that offline. For next week, what people can expect is for us to do kind of the same broad overview of this commodity trend following.
Yes.
And then if we come to some sort of idea of how we can make this live webinar work to walk people through this process step by step, then we'll go ahead and announce that next week.
Sounds good. Thanks for having me, George.
All right, buddy. We'll talk to you next week.
Cheers.